What is going on? Welcome to my channel. I'm the Covered Call guy, and my goal is to create 120,000 in annual passive income using Covered Call ETFs. Right now, my portfolio yields me about $76,000 a year, 6.3K a month, 1.4K a week, and about $200 per day. Legal disclaimer before we start: this content is for informational and educational purposes only and should never be considered financial, investment, or tax advice because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, I am just a random idiot you found online, found on YouTube, and I could be completely wrong. Now, today's video was requested from a comment left by a post I created. Ramen Mana Goodwin. I don't even know if I typed that right. Did I type that right? I might have misspelled. I think I said it right. So your request was to build an income portfolio based on age. Now, forgive me. I did kind of throw away 2 hours working on a pretty much a deep dive until I realized not everybody is going to go down the same path I'm going. So I kind of burned 2 hours building a portfolio based on age using only Covered Call ETFs until I realized, wait, not everyone is going to build a $1 million portfolio like I'm doing using Covered Call ETFs or to reach my $120,000 a year goal, right? So it'll be around about roughly $1 million in value. So this is what I came up with. I took another about 6 hours to kind of really sift through. This is going to be a spicy one because I feel like a lot of people are going to disagree, but you did not give specifics. So this is what I came up with: the 40-year wealth cheat code, unlimited. My opinion on unlimited income portfolio. Targeting the portfolio by age will target the yield of 10-15. That way we can say it's sustainable, reliable, and survivable. So I'm gonna get started on this. All right, just giving out full disclosures here. All right, so why I built this and who is it for? All right, so let's just reality check. These are my picks so far. I might have different picks in 2026. Why? Because historical data matters, right? So in 2026, or when 2026 comes to an end, all these new Covered Call ETFs or new CEFs or whatever have came out in 2026 or 2025 will now have a full year of data. Now that is why you don't see certain stocks, ETFs, CEFs, whatever is in here, BDCs, REITs, right? That is why it did not make the cut. So before you go, oh, why didn't you mention this? Well, because one of the rule was we need some historical data, right? I just can't put it there because it did great for 4 months. I can't just put it there because it came out the last 2 months of 2025, and yeah, it did great the last 2 months, but what about the next 10 months, right? So until it has at least a year, it did not make the cut. So in the comments, if you're still gonna comment that, then I know you didn't watch the video. Okay, so not everyone has the same risk tolerance as I do to go all in on Covered Call ETFs, like I said, and possibly rotate between them, like what I'm doing, right? So when I reach $120,000, once I reach that goal, I'm not gonna sell my Covered Call ETFs, but I might not keep buying Covered Call ETFs, right? I might just now rotate to some growth dividends or single stocks, whatever it is. I don't know yet. So that was my reality check. Now this is from the community request from you, seeing what. So the reason I stopped and wasted 2 hours was because it just dawned on me from my comment section It's clear many of you prefer a mix of covered call ETFs, CEFs, and dividend ETFs, right? So this is the blend I came up with. Again, the rule is we have to stick with at least, ideally, 1+ year of historical data. We are targeting 10 to 15% yield, right? We want the asset under management to be decent, right? So I just don't want to pick stocks just to pick them because they're giving out a high yield or they did well for 3-4 months. Not what I want. No matter the age group, no matter how aggressive I want to be, you're going backwards doing that. So hopefully you're content with my picks. All right, let's talk about the silent portfolio killer, right? The trap here. You've been told to focus on net worth, but the market doesn't care about your net worth. It cares about when you sell. If you retire into a crash and sell shares to pay bills, you dig a hole you can never climb out with. We're going to try to fix that with income immunity. I don't sell. I build an engine that pays me more than I spend. When prices go down, my income stays up. This breaks the link between market crashes and my solvency, right? So this is kind of, I'm telling you how I kind of came towards these type of picks for the age groups here. All right, my 3 non-negotiable rules for financial freedom. Structural yield, more than or at least 8%. I don't just hope for dividend hikes. I want cash flow derived from option premiums, credit spreads, or managed distribution right now. NAV resilience, right? I only pick assets with a proven ability to recover capital value after major stress events like 2008, 2020, 2022. As I said, historical data matters. Unless, of course, you're on the same exact journey as me and you are willing to have that risk tolerance to go into covered call ETFs until a certain goal. And then last, tax alpha. I'm trying on my picks. I'm gonna try to utilize Section 1256 contracts, return of capital, and municipal bonds to maximize what I keep after the IRS takes its cut. So these 3 are kind of like my anchors when I'm deciding what to pick, especially for different age group, right? So for in my early 20s, I might not really care about the structural yield, or I might not really care about the NAV resilience, because in my 20s, this is where I can be the most aggressive, right? I'm just saying, if you're kind of thinking like me. If not, you can kind of, in your 20s, you can still be moderate, less conservative. That's okay too. All right, the option architectures, right? Tax hacks and massive yields. These ETFs solves the historical flaw of covered calls, which are capped upside and high taxes, right? So SPY-I from NEO's S&P 500, core equity income yield is about 12%, right call options on the SPX using Section 1256 contracts, giving you a 60-40 tax split, right? 60% long-term game, 40% short-term game. Crucially, it uses credit call spreads to capture melted upside, which just means it kind of give you that NAV gain, right? To give you a NAV capital appreciation. QQI from NEOS also, right? Growth income yield is about 14 to 15%, captures higher volatility premium of tech stocks while retaining Section 1256 tax efficiency. And then JEPQ, the Titan, right? The biggest assets under management. They are the biggest boys on the block. JP Morgan, NASDAQ, this is the institutional defense. Yield is about 9 to 10%. Uses ELN. Kind of sucks that is not really tax efficient, but it is what it is. Lower beta makes it superior stabilizer in tax advantage accounts, but again, if you don't want to be a tax advantage account, this is still a great pick. All right, the banks for the rich, right? Private credit titans. My private credit fortresses acting as a bank for private equity, right? So ARC's Capital, Ares Capital, ticker symbol ARC, ARCC. This is the Goldman Sachs of private credit, right? The yield is about 9 to 5, 10, depending on the price range, right? It could be anywhere from 8 to like 10, 11, 12%. I'm just going to look for the middle here at 9.5. So don't go and berate me in the comments for that. Navigated every single recession since 2004 without cutting its base dividend, okay? That's very important here. My second is, if you don't like ARC, my favorite is Main Street Capital. This is the compounder. Yield is about 6 to 8%, paid monthly, internally managed with a uniquely strategy that grows NAV per share over time. Why is Maine I used to own Maine, by the way, before I went straight into cover calls. I had like 80, 50, 60, $80,000 in it. I absolutely loved it. I was trying to build up a $100,000 position in it, but I bought in the low 30s and then it just shot up to like 50s. I was like, oh, I can't even freaking buy the dip. So why do I love it? I'm going off track. Why do I love it? Because they give supplement dividends. Oh, I love that. They paid like they paid me on the 14th or 15th of every month. Plus at the end of the month they paid me like a little bonus per share. They gave me either the same payout or like 5 cents more per share. Loved it. Maine was my baby. All right, HTGC, Hercules Capital, right? Venture debt growth. Yield is 9 to 10%. Lends to VC-backed tech firms and takes warrant for massive equity gains. So these are the three. You might pick all three. You might pick one. Up to you. Just keep these in mind. All right, my secret weapon funds, right? Active Alpha, part 1, because I couldn't put it into all slides without it going off. So this is part 1. Just remember this. All right, so the ticker is PTY. This is the bond king, right? My edge here is that is managed by PIMCO, uses leverage and derivatives to extract alpha. Traded at a premium for decades. Yield is about 10 to 11%. STK, this is the tech alpha, is a unicorn fund. Concentrated tech stocks plus calls, rivals NASDAQ total return with massive yield. Yield is 7 to 9%. And then BST, unleveraged growth. Exposure to private unicorn tech, right? For example, it's if you Google Project Diamond, recently adjusted strategy to manage distribution. Yield is about 7 to 8%. All right, part 2, ticker USA, Rose Auto Stabilizer. My edge here pays exactly 10% of NAV per year. Self-healing mechanism to prevents the fund from eating itself alive. RQI is the inflation hedge. Leverage REITs, data center, towers, etc., etc., right? Real assets floor tracks inflation. Yield is 8%. If you want another, it's not leverage REITs, but if you want another REIT, O, ticker symbol, literally just one letter, O, Realty Income. It is lower yield at about 5%, 5.5, around there. Another great real estate, but it's not leverage REITs. All right, UTG. The row here is my defender. Boring essential utilities, right? It never cut its dividends. Bedrock for my older portfolios at a yield of 8%. NMZ, tax-free income, high-yield municipal bonds, essential for high earners to reduce tax drag. Yield is about 6%, tax-free. All right, the wild cards, right? Uncorrelated income, right? We have PFFA, active prefers, uses leverage and active management to exploit inefficiencies in preferred stocks. Preferred sits above common stock for safety. Yields about 10%. And then we have the hedge, SVOL. They just shorts the VIX futures, profits from calm, but buys call options on the VIX to hedge against black swan crashes. It zigs when the stock zags, so it gives you a nice yield of about 16%. These are just the wild cards. These are just for something that, hey, you know what? Remember we talked about satellites? These could be your satellites. All right, so age 20. This is my quick get rich quick phase, right? This is the accumulation phase. This is where I want to be. My objective here is max total return. I'm taking the most aggressive risk here in my 20s. All right, so these will be my picks. Again, remember all of this. This, and this, and this, right? You can substitute here. You can substitute all of this. This is just for me. I'm okay with just this. However, if you're not happy with this, you can substitute. You can be a little bit more conservative. You can be even more aggressive. Up to you. But in my 20s, if I were to go down this path, this is what I would pick. A minimum of 10, a maximum of 15. That was my rule here. A minimum of 10, so then I'm not concentrated. A maximum of 15, that way I'm not all over the place. So each pick has its role. QQI, 20% is a core, right? So my row is growth engine. STK, 15%. Tech equity. HTGC, 10%. Venture growth. BST, 10%. Is unicorn. SCHD, 10% is my dividend growth, right? And then main, my compounder. SPY, my core income. ARC, my credit anchor. PFFA, yield boost. SVOL is my hedge. Now you can remove the bottom two and go for JEPI, JEPQ. Completely fine too. Absolutely fine. It just depends how aggressive you want to be. Alright, age 30 is the empire builder phase, right? My objective in my 30s is balanced growth, adding credit stability. So these would be the 10 picks. As you can see, I'm starting to rotate to be like, okay, I want to be a little bit more defensive here. I'm not in my 20s anymore. So I see DGRO, right? I kicked out SDHG for a little bit slightly higher yield, still the same dividend growth, right? I have USA now. So again, you don't have to kick anything out. It just depends on, if you still want to be aggressive in your 30s, that's fine too. But for me, remember, this is my pick. For me, I want in my 30s to start, I want to start thinking, okay, what if I can retire in my 30s now? This is what I would go. Again, this is just an example of the 10 picks. There are probably better picks, but I kind of have to make it so that my portfolio kind of has a covered call ETFs, single stocks, CEFs, BDCs, and whatever else is constantly being commented, because I know a lot of people aren't just going to go the same path I'm going. All right, age 40 is the tax assassin phase, right? This is the prime. What I mean by that, my objective here is peak tax efficiency, heavily using 1256 and municipals. Why? Because at age 40, I might have already been retired, right? I don't know. If you're okay with being done just working and retiring, then this might be a little bit different too. You might even get more defensive, right? You might not want to hedge here. You might start kicking out PFFA and rotate it into a more, you might stick with, you see here, QQI is gone. You might replace with QQI, and you might start, going down the path of, okay, I want more tech that are still able to grow, So that's why I say keep these in mind right here, okay? Right here, keep these in mind, because these ETFs, you can I didn't put it on a list, but you can still keep them. I'm just trying to think, what would the viewers and subscribers, how they would want the portfolio, right? Not everyone's gonna go kind of think like a crazy person like me and go, you know what, I'm just gonna invest $1 million into covered call ETFs and let's just see how it turns out. Not everyone's gonna go down my path. All right, age 50. This is the safety net phase, right? This is where you're gonna go, okay, I want reliability. I'm shifting to recession resistant assets. This is probably where we're most afraid of, like NAV erosion, right? Or ETF or the fund failing. So now we really have to start narrowing down to, okay, I only want companies that have been through the recession, that have strong reputation, strong assets under management, right? They can take the beatings if the economy takes a huge dump. This was my pick. This is what I filtered out. Again, I am trying to have a decent amount of single stocks, covered call ETFs, REITs, BDCs, right? I'm trying to kind of be balanced here. All right, and then age 60 is the sleep well phase, right? This is the absolute fortress here. My objective is survivability. I'm trying to maintain a 10% yield where I never have to sell principal ever. That 10% yield should be 100% able to push me through well into my 70s, 80s, 90s because it should last me a lifetime. Right, 10% is very sustainable. And so how does this profile survives anything? One, I think about self-healing, right? Funds like USA pay strictly 10% of NAV. If the market crashes 20%, the dividend cuts 20%. This preserves the golden goose principle. Two, tax drag minimization. Over 40 years, right? If you start at 20 to 60, taxes destroy wealth. I have Section 1256 with using 60-40 splits and minutes that is tax-free. Save me a huge amount compared to standard income. And three, all-weather rates, right? Rising rates boost BDCs, right? Floating loans. Falling rate boosts bonds and utilities. I have a natural hedge regardless of what the Fed, the economy, whatever is happening. So that's how I came to be. That was my pick. Right, so my final verdict is this the infinite money glitch, right? So secrets of return immunity in the fortress of, when you're 60 plus portfolio, the organic yield is 10%. If I do withdraw 100,000 from a 1.5 million portfolio at a 6.6% withdrawal, I never have to sell a single share to fund my lifestyle. This renders the daily fluctuation of stock prices irrelevant to my solvency, providing me true financial peace of mind. So you can see here on the right, age 20 is when I was most aggressive at a 10.5%. Age 30 is 11% balance. Age 40 is 11.5% peak tax. Age 50, I start to transition for 11% transition phase. Age 60, I start to build up my fortress. And if you found this interesting, if this was any way helpful, again, go ahead and smash that like button, right? Subscribe for more wealth hacks if you think this was educational, informative, and comment below what age bracket are you in now. And comment below if this was the type of video you want. Now, if you want strictly cover call ETFs like what I'm doing, easy day, leave a comment. I will do that. No problem. I will give you the cover call straight top 10, 15 cover call ETFs that I'm going to be pretty much buying, that I think will go ahead and do well in your 20s, 30s, 40s, 50s, 60s, 70s, 80s, and 90s. Let me know, because that is my journey. So if that was what you're looking for, because you weren't specific about it, you just said pick the top income ETF, income stocks based on age. So that's what I did. And I have a lot of viewers that don't just go crazy with just cover call ETFs. So I got a few. If that's what you wanted, let me know. If that's not what you wanted, let me know, and I will make another video as long as you're specific on what you want. So hopefully I got something informational for you though. Thanks for watching. Catch you guys on next. Stay tuned.